य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता 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 एतद्द्वैता.
Mohan sir, welcome sir.
Sir, namaskar. Bhavaram.
Yeah, doing good sir. Great.
Good. Okay.
Career Narayana.
Okay, let me give my opening remarks as the chairman. And speaker of today's technical session, CA Mohan R. Levy, sir, and colleagues at the managing committee and past chairman of the branch and coordinator of this entire program, CA Godavati Srinivasarao, and my dear fellow members, very good evening to one and all. My hearty welcome to you all for the fourth day of 5 days virtual refresher course on 360 degrees of annual report organized by Corporate Law and Corporate Governance Committee of ICA, hosted by Vijayawada branch. Our today's topic is accounting standards applicable to small and medium companies, focusing mainly on AS16, AS15 employee benefit, and AS16 borrowing cost, and AS18 related party disclosures, and AS26 intangible assets, and AS28 impairment of assets, and AS29 provisions, contingent liabilities, and contingent assets. Our today's speaker, CA Mohan Levy sir, is with us to explain you about what is the director's responsibility in compliance of good standards and auditor's role and responsibility, and also the disclosure requirements when there is non-compliance. I request you all to have active participation and get benefited out of the session. Thank you, one and all. Okay.
Thank you, madam. Before commencing the session, I brief you the today's session speaker, Mr. Mohan R. Levy. He qualified as a chartered accountant in 1989. He has over 25 years of experience in industry across a variety of industries. He has worked in senior positions in finance, in manufacturing, and software companies. He also has over 6 years of experience in practice. At present, he is a partner with Messrs. KP Rao & Co. Chartered Accountants, Bangalore, and heads the IN-AS and GST practices of the firm. He is the author of books on IFRS, IN-AS, key audit matters, and other related topics. Mohan has spoken at various conferences in India and abroad on accounting standards, IFRS, Sarbanes-Oxley, and GST, and is a faculty member with the Institute for the IFRS certificate course and registered value programs. Over to you, sir.
Thank you, sir. Thank you very much. Can you see the screen?
Yes, sir.
Right. Okay, sir. Perfect.
Right. All right. Okay. So, first of all, I should thank Srinivasarao Garu for inviting me to speak on this topic. I think it's a when I saw the topic 360 degree annual report, I was very excited myself because I have not seen any such program done by any other, sort of institution. And I think also it's very important in the present day in which we are living to look at the responsibilities of the management as well as the auditor. I mean, auditor, we all know we've got audit report, we've got SA 700, 701, all that we know about it. But I think what is not been spoken about too much is what is the responsibility of the management. In our audit report, we say that, okay, these financial statements are responsibility of the management. That is a part of our audit report. What is the management saying? what is their view on these compliances, or in case there is an issue with the compliance, what happens there. So I really should congratulate for conducting such a program, because I personally believe, and I think many of you who are participants will agree with me, all this non-compliance hits the small and medium people only the most, not the big people. If there is a non-compliance, the big people somehow get away with it, whatever manner they want to get away with. The small and medium enterprises who are suffering a lot because of certain issues of non-compliance, though there are some disclosure benefits given to these small and medium enterprises, but still I think one of the things which all the participants should definitely think about today, after this course is probably over, is the fact that disclosures are increasingly becoming important from the auditor's point of view. For a moment, let us keep the management away from this discussion. We'll come to the management later on. The auditors, the disclosures given in the accounting standards, we know that, okay, there are certain set of disclosures which have been given. But over and above that, if the auditor wants to look at some additional disclosures, there is always scope. There is always provision in the accounting standard to give that sort of a disclosure. So I'll be taking up these standards today because of the fact that when we looked at as I said, the theme of the conference, of the session was 360-degree, of the annual report. Recently, I was in a conference in Bangalore, in which panel discussion in Bangalore, in which somebody asked me this question: who reads the annual report? Does anybody actually read the annual report, which is nowadays 500, 600 pages long? Does anybody actually read the annual report? So we can break down the annual report into two sections. One is the information which the management has to give. The other is information which the auditor has to give, or what comprises the financial statements, which I think is what is going to be the theme of today's session. I've got 6 standards to cover in 3 hours, which gives me, almost very limited time for each of these standards. But to all of you participants, none of these standards are actually new. None of these standards are new in the sense that they are not new accounting standards which have been prescribed by the Accounting Standards Board or by the company's accounting standard rules. So we all know about these standards, but what I will probably like to take you all through is a few of these intricacies or nitty-gritties in each of these standards. And I will be focusing more a little bit on the management's responsibility here more than the auditor's responsibility. I will also cover the auditor's responsibility. But if you look at, for example, impairment of assets, I think impairment of assets standards, it is meant only for the management. The auditor can always come in later and do the checking and all, but how does an auditor actually know that an impairment has happened or there is a possible impairment there? So if you look at these standards very closely, you will find that many of these standards are also having provisions which the management of the enterprise, nowadays we use this beautiful word called those charged with governance, TCWG. The TCWG will have to give their inputs also. And I'm also seeing a change in the way management is approaching this. There also, many of the managements are taking these things also quite seriously. That is the entire purpose behind today's session there. I would like to say a few things upfront because we don't have to discuss about them later on. And I think one of the things which I definitely have to say is that if there is a non-compliance with an accounting standard, there is no option for the auditor but to report it. I think this is something which all of us will definitely have to agree on. If there is a non-compliance with the accounting standard, auditor will definitely have to report this in his audit report, because I'm not saying that you can get away with it by putting a disclosure on the notes and accounts and all those things. All those days are long gone now, because we cannot escape from the fact that there's a non-compliance. I'm also a little bit more careful in the present day and age wherein a lot of information is going around. We've got IBC, we've got income tax, everybody are talking to each other. I think if you had asked me the same question 10 years back, I would have probably said, okay, non-compliance doesn't matter, chhod do, koi problem nahi, nobody is going to know about it. But today, I do not know where that information is going to come from. It may come from the IBC, it may come from income tax. Now we've got this AIR. I do not know where this information is going to be picked up. The company law board is looking at XBRL very closely. They are actually issuing notices based on some XBRL formula they have got. So I think this is one thing which I definitely wanted to tell all the participants. Many of you who are auditors and who see a non-compliance, option 1 for the company is that please comply with the accounting standard. If that is not there, option 2 is you will have to give a qualification in the audit report. Or I mean, you can put it in whatever. You've got so much of space in the audit report now. You've got key audit matters, you've got emphasis of matter, you've got a qualification. You can put it wherever you want, depending upon the extent of non-provision, non-compliance. But I think one thing which we should definitely agree upon is the fact that we cannot get away with non-compliance of an accounting standard. I'm sure that other speakers have also told you all this, but this just may sound like a repetition. The second thing which I wanted to tell you all, and which you can use as a placeholder for the remaining of the session, is that we have been speaking about expectations of the management. Who is this management? Is it the CEO of the company, MD of the company, CEO of the company? We have also used this word called as those charged with governance. In my opinion, at least as far as the audit and financial statements are concerned, those charged with governance will be the audit committee. I think we should give more and more importance to what we report to the audit committee. I'm talking about a general situation wherein a company has got an audit committee. In case there is no audit committee, okay, those charged with governance would remain the management people only. It is very important for the auditor to keep conveying his findings, discussions, discoveries, or whatever it is with the audit committee, so that they are also aware of what is happening there, and they can also take a necessary decision on whatever those matters are going to be. So these two things I wanted to put to all the participants up front. Both these are equally important. Both of these are equally important. And I'm not looking at any of these accounting standards in isolation. I'm looking at the total number of accounting standards, and I'm assuming that there's a complete compliance with all those accounting standards. I'm not going to talk too much about Ind AS today because this session is meant only for the small and medium enterprises. So we will not worry about Ind AS. But I would definitely like to inform that you should take non-compliance a little bit very seriously, because of the fact that it could have serious ramifications, as I have told you. Now, if you look at these standards, I will be doing employee benefits, borrowing cost, related party disclosures, intangible assets, impairment of assets, and provisions. All are pretty interesting standards. I will not spend too much of time on employee benefits because I think if you ask any chartered accountant of the country, which is the most boring accounting standard, he will say AS 15 only. Because there is nothing for him to do in the AS 15. Everything the actual valuation is doing. What does the chartered accountant or the auditor do in AS 15? I think this is a very popular thing. You can ask anybody which is the most boring accounting standard, he'll definitely come out with AS 15. Because the standard is more a disclosure standard than an accounting standard. Okay, we've got short-term, long-term, we've got termination benefits, we've got all those things which we'll be discussing in brief. But again, I would say that it is more a disclosure standard than it is an accounting standard, because accrual base of accounting, we definitely have to follow if it's a company. So there we'll have to do the basis of accounting would have to be on a accrual basis, and employee benefits, we all know what is going to happen to employee benefits. Borrowing costs and related party disclosures. I mean, borrowing costs, we know about those things, not much of complication there. It's only that capitalization rate, which is very, very important. And there's a little bit of a calculation required for a forex borrowing. The interplay between between borrowing cost and your forex differences. I will take you through an example for that. Although this is given in the standard itself. Related party disclosures. Again, I would like to give a bit of I won't say caution, but advice. If I'm allowed to give that advice, please be very careful with related party disclosures. I am telling this from experience more than from what the accounting standard says. You can look at whatever has happened in any of the big companies which have reported problems in India. Every single transaction can be traced back to an issue with a related party transaction. I don't want to put the names in here, but you can always look at Satyam, you can look at ILFS, look at any of these big problems which have happened. There has always been a related party involved. If you go a little bit deeper into the transaction, you all will find that there are, issues with the related party transactions. For a moment also, I am not saying that you should not do related party transactions. The reason why the standard is there is because you're allowed to do it. You're supposed to give some disclosures. That's the only reason why the standard is there in the first place. But we also need to exercise some caution here because of the fact that it is easy for non-compliance with a related party, because when entering into the transaction, we will always feel that related party, we can take care of things whenever we want. Because anyhow, they're a related party. They will do whatever we want and whenever I want. So that is a sort of a dangerous sort of a situation to be. Intangible assets and impairment of assets also I'll be looking at. And I'll also look at provisions, contingent liabilities, and contingent assets. Though I told all of you all that I will not be, looking at Ind AS, other reason why I'm telling that is also because you look at, for example, AS 29. 85% it is as per IAS 37 or Ind AS 37 only on provisions, contingent liabilities and contingent assets. So the present set of AS which we are seeing now, at least many of these ASs, are almost in tune with the Ind AS standard. So there are a few small differences here, which should be there because we have not gone for an adoption approach. We have gone only for a convergence approach. So therefore, there will always be a few differences. And we are talking about AS here, which is applicable to non-Ind AS companies. So this is the brief about these standards I'm going to look in today. And of course, as we go along, in case you all have any questions, we can always look at answering these questions. I have also already shared this presentation with the Vijayawada branch. So in case anybody is having or requiring a copy of this presentation, please feel free to reach out to the branch, or you can always, later on, I've got my details here. You can always fall back upon me. I will also give you this presentation in case it is required. Okay, the first we go with is, I will quickly take you all through the levels, though this has already been done, I'm quite sure, but it's just for the purpose of a quick recap. We have got 4 levels now: level 1, level 2, level 3, level 4. And this is what the IC had announced on 31st March. Level 1 companies are those which are already given here on the screen. 250 crores. 250 crores seems to be the benchmark now. Even NAFRA seems to be liking companies who are only above 250 crores. And they are level 1 companies. Absolutely no relaxations. Absolutely no relaxations for level 1 companies. Listed companies about to be listed. You have filed your DRHP with the SEBI. All of those companies are level 1 companies. Level 1 companies will invariably be Ind AS compliant also. Invariably, they'll be Ind AS compliant. So this present set of accounting standards may not apply to them in the first place. Level 2 companies are, I should refrain from using the word called company. I should say entity, because it's also applicable to non-companies. 50 crores, but up to 250 crores. Or borrowings, including deposits in excess of 10 crores, but not in excess of 50 crores. And the holding and subsidiary companies of the above, level 2. Level 3 is also based on a turnover criteria, 10 to 50, borrowing criteria 2 to 10 crores, holding and subsidiary companies of the above. And level 4 company is only a default category. If you are not in level 1, level 2, level 3, or in level 4 company. I am sure this has been told to you, so I'm not going to repeat that. But the criteria for level 1, level 2, level 3, level 4 is based on turnover and borrowings and a holding on subsidiary company of those above companies. Whichever level you are in, those companies will be at that level here. So this is the reason why these 4 levels are being given by the ICAI. And of course, the reason also is that, the reason also is that we always have this discussion. The cost of complying with accounting standards should not exceed the benefits. Now, this is a very simple thing for me to say, but the benefits from accounting standards, in fact, the benefits will probably be in the form of, in case you do not follow, what is going to happen. So that will be the problem in case of you're looking at benefits of an accounting standard. So this is the levels which have already been discussed with you all, I'm sure, but there are very few relaxations, mostly in terms of disclosures in these accounting standards. We will first take up AS 15 on employee benefits. As I have already mentioned to you all, this is more a disclosure standard. The standard talks about 4 categories of employee benefits: short-term, post-employment, other long-term benefits, and termination benefits. Now, I will typically put this in the Indian context, because in jurisdictions abroad, you all may have different types of types of payments to employees. In the US, for example, salary is paid twice a month. The same salary but divided by 2. They pay once in the 15th they pay. Many companies prefer to do that because they want more liquidity in the hands of the people. But in the Indian context, if you take it, you will invariably have salary which comprises those heads of salaries you're all very familiar with. See, one of the interesting things about this breakup of salary is that I'm sure that all of you all are aware of this. This salary, basic DRA, HRA, conveyance allowance, and all those things. Why is it packaged that way? Only because of income tax benefits, income tax reduction. The reason why it is packaged that way, why can't I give a, let us say, conveyance of 10,000 rupees per month? At 800 rupees or whatever, 1,000 rupees, whatever that limit is today, has been fixed many years back. It is not going to be useful in any city also. But the structure is only for the purpose of income tax benefits. So if you are eligible for a deduction, it forms a part of your package. So those are what we call as short-term employee benefits. Post-employment benefits. Post-employment benefits, I can give a good example of gratuity, which again is a very popular example we have in the Indian context. Once you finish your employment, you get a benefit of a gratuity. Other long-term employee benefits, there could also be, for example, some entities give some medical allowance after you leave also. They give medical insurance, they pay your medical insurance after you left the company also. So those also would come under what is called as other long-term benefits. And finally, we have termination benefits. Termination benefits are basically what you will get when you are terminated from employment. When you are terminated from employment, when you are leaving the employment, termination can have different ways, as we'll quickly look at as we move along. Because again, here, the responsibility of the management to disclose properly all these things is very, very important. Many of you would have probably heard, maybe about 8 or 10 years back, there was an issue with the termination benefit paid to an Infosys CFO itself, the past CFO. That is why I'm going to keep on repeating, why is the management involved here? What is the management's role in these disclosures? Employee benefits, ultimately, as far as the auditor is concerned, as long as the classification is as per these 4 categories, as long as the accounting is on an accrual basis of accounting, as long as there is an actuarial valuation report which will justify the actuarial gains and losses, the actuarial valuation report also contains every single disclosure required by AS 15. The auditor is pretty much done with AS 15. He does not have to worry too much about it. But it is up to the employer to come and tell the auditor in case there are, say, for example, special bonus schemes. In case they are non-cash components in anybody's salary package. It's up to the employer to come and tell us. We will not know about it. We will probably, anyhow, we're going to do only a sample check. But how vast is going to be our sample check, whether we will cover all these things, these are issues which we are not very aware of. So we will put the responsibility upon the employer. Employee benefits also includes to that children, spouses, and other dependents made directly by the company. Also to any trust or insurance companies. Many companies have got their own trust for the purpose of your gratuity scheme. That also would be a part of your employee benefit standard here, AS 15 revised. Always, when you're referring to the AS 15 now, please refer to the AS 15 bracket R or revised, because this is on par with your Ind AS 19 on employee benefits. Now, one of the interesting things which the standard says is that it is also applicable to part-time employees, permanent, casual, or temporary basis. This is a very interesting insertion made by the standard. because see, normally a casual worker cannot be considered to be an employee. There always a friction there between why is he and what will I apply to casual worker. Okay, accrual basis of accounting we will do, definitely we will do accrual basis of accounting. But do I have to look at the other disclosures and all which are required? The answer is probably going to be no, because even though the standard talks about these people on a temporary basis also, it means that you are taking an employee or taking a casual worker as an employee. Many people have got this, logic, I should say, in which they say that a person, if is an employee, only if he has got a PF benefit. May not necessarily be true in all the companies. Only if he's enrolled to the PF in my company, I will ask him to be an employee. I'll call him to be an employee. May not necessarily be true, because the standard has got a wider definition for this. And as I have already mentioned, all they require is classification of the benefits into 4 categories. You may not call a casual person an employee, but you will still have to, classify it into those 4 categories here. So I think that is what becomes very, very important from the point of view of the, employer, so to speak. Okay, now if you look at the short-term things, all of us are aware of this. So monthly salary is paid as per those heads of account. Liability, expense or prepaid, they say. Accrual base of accounting means end of the month is over, 30th of the month is over. That person has completed his service there. You are eligible to pay him, or you are obligated to pay him. He has got the right to receive. So accrual basis, create a provision. When you actually pay him off, set off the provision. If you pay him more, show it as prepaid. Very simple accounting given in AS 15. Create a provision, set off the provision on payment. If you are paying excess for whatever reason, I'm not talking about employee loans here, salary only I'm saying. I'm not talking about employee loans, because employee loans will be shown as employee loans. In case you have paid them excess, you please set it off in your as a prepaid expenditure, and you can amortize it over the next month's salary or whenever that amortization is possible here. A quick question which has been asked by Murugan, who says that what do we do if actuarial valuation is not done on the basis because of cost? What is an auditor's responsibility here? Murugan sir, I'll tell you very clearly, of course, the costs of actuarial valuation report are not very costly today. So maybe, that is not a reason to not have an actuarial valuation. But to answer your question directly, if you are saying that, can I do on an estimated basis? AS 15 is very clear. The answer is no. You will have to definitely have an appointed actuarial, and you'll have to definitely get an actuarial valuation report. Can I not appoint an actuary and show in the notes and accounts and accounting policy saying that this is done on an estimated basis? Again, I would not step into that category. I would not advise it also, because it will be a non-compliance with an accounting standard. So my advice would be, please ensure that you get an actuarial valuation report. There are people who will give it for a pretty minimal cost, but I don't think you can avoid the fact that you should get an actuarial valuation report. That cannot be done, in my opinion. So I think you should just push it upon the management. Okay, what disclosure is made if LIC policy is taken? LIC policy also same thing only. Actually only will give you the basically your defined benefit plan, your actual gains and losses, fair value of plan assets, investments to be made, and liability will be a part of the actual valuation report only. So the actuary will get that information from the LIC, and he will give that necessary report what is there. But I don't think you'll have to do anything for the LIC. Apart from mentioning that the company has got a gratuity policy with the LIC or Life Insurance Corporation of India. There is no accounting or disclosure requirement from the LIC's point of view, or whichever agency you are going to for the purpose of this thing here. See, the short-term compensated absences, this term we are using from IFRS actually. If we tell leave encashment, we don't understand. They also got used to using all these foreign expressions. Short-term compensated expenses means nothing but leave encashment. Now, all of us know there are two types of leave encashment. The one in which, or the leave policy, so to speak, one in which they are saying that as the employee provides service, his leave entitlement increases, which means he need not cash it out. He'll be eligible for the leave. There'll be a carry forward of the leave also. He will still be paid for that time also. The option number 2 is, or the other type of leave is, out of the total leave which is eligible for, one portion, one small portion, he can encash at the end of, let us say, 1 year. Or 1 year, or maybe sometimes 18 months in a few cases. And normally it's annual. So both these provisions are there. Encashment, there is no problem. I had to create a liability because it's going to be a cash payment out. Accumulated leave balances will also be short term, because even though he is not working, I'm still paying him for that. When I'm saying I'm paying him for that, I mean that we are, compensating him for that. So that's a benefit for them, right? So both of these categories would fall into the category of leave encashment here. So we will use the word called as leave encashment. So I have two situations here. Situation number 1, end of the year, I know that out of my 200 employees, 80 employees are eligible for leave encashment of 5 days. I will use that calculation to get it. Nowadays, of course, this also has been given by the actuary, but strictly speaking, we can do an estimate ourselves, because I don't require any actual valuation report, for this purpose. For leave encashment, I don't require it, but many companies do it because anyhow gratuity also is being given there, and normally leave policy continues for 4 or 5 years, just like gratuity. So they would prefer to do it like that. As far as what the balance is there, leave he is eligible for, that will be a short-term benefit that will go along with my normal benefits. Very small example given in the standard, 5 days leave or something he has said. And, they have said that 8 people will take 6.5 days leave, which means basically what they're trying to say is that they're eligible for 5 days. 8 people will cross that 5 days and take 6.5 days. So 8 into 1.5, which is the excess over 5, 12 days will be accounted for as short term. This is not encashment. This is what is your normal salary, what you're going to pay. That would, because you look at on an accrual basis of accounting, you will still have to provide for this. You will still have to get a salary for this particular, this thing here. Okay. Another quick question. I'll answer the question as they come. I hope it's okay with you all, because it makes, because there are, in case a lot of messages come in, it will be difficult to, keep track of those messages. There was one which was asked recently by, let me check who this is. John Matthew, sir, whether we should pay directly to the LIC, or whether we can, we have to form a trust. I think the accounting channel will not give you any guidance in this, John Matthew, sir. It is the entity specific. But normally what will happen, the entity would prefer to have a trust if they are giving other benefits also. Like, for example, sometimes stock option schemes are there. So if it's a small enterprise, 40, 50 employees, and no other benefits like compensation, like stock compensation or, you can pay directly to LIC also, no problem. You still have to get an actual valuation report. That you cannot miss. Trust is normally formed when there are a large number of employees, and there are other benefits which are given to employees apart from your, only your gratuity. There'll be other benefits like medical benefits given. They have policies which will be renewed every year. They have new employee benefits will be given by the trust. Few employee members will be a part of the trust. So that is a slightly bigger enterprise, a slightly bigger, thing to do. But standard is not going to tell you anything. You can choose what you all want. There's no mandate that you have to have a trust. It's entity specific, but AS 15 revised will only say that those benefits are there. You create a provision for those benefits depending upon what you want to create as entity specific, which means that you may have only a gratuity policy. You may not have leave encashment at all. Why do you want to go to natural valuation? That's not required there. You may not have a bonus plan at all. You may not have a medical insurance plan at all. Why do you want to go for the trust there? You can go directly to LIC and do it in a simple manner. So it's entity specific. Nothing will come out from the accounting standard. Small and medium enterprises may not comply with the short-term agreement which are non-vesting. So what they are basically trying to give us, I told you, disclosure exemptions given the standard. If you are not entitled to encashing of the leave benefit, like I told you those 12 days which I gave in the previous example, if you are a level 1 company, you have to account for it. You will have to make a provision because it's a short-term employee benefit. Provision for leave encashment, you should give it. But here they are saying that if it's a level 4, level 2, level 3 company, level 2 non-company basically, you need not do it if that encashment is an option is not there, which basically means to say that in case there is non-vesting, in case there is not entitled to a cash payment, you need not do the recognition measurement of those, but you can give an omission, or I won't say omission, or you need not account for that as a provision basically. So in short, what they are saying is account for leave encashment is actually encashed. Account for leave encashment is actually encashed. I should tell you all that these are only optional. If you have a policy of creating a liability for that, please go ahead and create it. There's only optional, not mandatory. This is about employee benefits as far as the gratuity and all is concerned. Very interesting thing on profit sharing and bonus. Now, many people nowadays, of course, they feel that bonus is really a bonus only because we do not know when it will come. As you should ask an employer, they'll always say, I do not know what bonus policies this company is having. Bonus becomes interesting in the Indian context because normally what entities will say is that bonus is payable at some percentage of your salary. In some cases, a fixed amount also. And they say that it is based on the basis of, they'll put 1, 2, 3 conditions. The standard says that you make a provision, present obligation as a result of past events, reliable estimate can be made of the provision, you have no alternative but to make the payments. The word obligation becomes important here. I have got an employment letter. I've got a contract of employment with my employer. He says at the end of every year, depending upon the profits of the company, you will be eligible for a bonus of, let us say, 5 lakhs of rupees. Depending on the profits of the company becomes a very important sentence here. Okay, the profits of the company has always been profitable in the last, let us say, 10 years. Is he obliged to pay me that bonus? The obligation comes from the employer. He has said that if the company is profitable, you will get a bonus of 5 lakhs of rupees. As I've told you, the company has always been profitable. So I have no doubt in my mind, nor does the employer have any doubt in his mind that this bonus will have to be provided for, because in 99% of the cases, I will meet that profit estimate. So therefore, the bonus has to be paid. Is he obliged to pay the bonus? This is called as a conditional obligation. I always give this example while talking about this. Any one of you all can answer on chat very fast about this. I mean, I still have to ask the question. Many of you would have probably heard that in Surat, there is one person who's running a diamond cutting company or diamond cutting factory or whatever it is. Every year, nowadays, of course, it's come to other places also. The employer gives Diwali bonus in the form of gifts. To some employees, he gave cars. To some employees, he gave diamonds. It is not in the form of a cash bonus like all of us are entitled to or are used to getting, but it is in the form of gifts only, cars, those type of things. The question I'm going to ask you all is that today we are on May 26th. Diwali is probably sometime in October or November, whenever Diwali comes. This person has created a habit of giving Diwali bonus to employees every year. Whatever may be the amount, but he has got a habit of creating a bonus, giving a bonus. So we know that he is definitely going to give a bonus. We are today on May 20th, May 26th. The question I'm asking all of you all is, can he pass an accounting entry today for bonus to be paid in the month of October or November, whenever it is? Can he? We know that by habit he is going to pay. Contractual obligation. Every year he is going to pay. Let us say that this year he has decided to give everybody Tesla car. Let us. Tesla car is too much only, but still, assume it. Maybe some people are lucky they will get a Tesla car. Who knows? But we'll not go so far. We'll look at BMW only. Because car is always. So my question is to you all is going to be that, can he create a journal entry on May 30th for a bonus to be paid in December? Is that, can I call it as an obligation? See, you don't worry about present obligation. We worry about present obligation later on. Present obligation means the obligation because of there should be a past event for that. But here, is he obliged to pay? The answer to that is going to be very clear. Suppose he has identified 5 employees and he tells them that, "Dekho boss, December time mein aapko Maruti car milega. You will get a Maruti car in December time. I have identified you. You will get this benefit in December." Can the employer or the employee, can the employee claim that in the month of June? The answer is no. He can claim it only in December or November, whenever the Diwali event comes. So it's event specific, it is event based. The employer does not have an obligation today. Obligation arises only when that event occurs. Only when that event occurs. So if the employer goes and asks somebody that, if he goes and asks an employee goes and says, "Mereko chahiye, BMW car chahiye or Maruti car chahiye," he's going to say, "No, wait up to this thing here." So passing the journal entry may be a wrong thing to do now, unless, of course, he says the obligation is open right from now to Diwali time. Whenever you want, you can take it. That's a different way of looking at it. Why this becomes important? I am giving this example. This is an outsized example of Maruti car and all those things. You take your normal bonus. You take a normal bonus, which every employee is probably eligible for. At least he assumes he's eligible for. My contract has got an employment, I told you, 5 lakhs of rupees. That he'll have to create a provision because of the fact that it is contractually obliged to pay me that. I am assuming that there are no conditions in the contract. Stock option schemes can be based on various things, profit of the company, profit of competitor and all those things. But a normal plain vanilla bonus, which is based on my contract, he can definitely make a provision for it based on, because the employer is obliged to pay by that contractually he is obliged to pay. The long-term benefits are basically 2 things. Defined contribution plan and defined benefit plan. Again, you can replace these words. I told you, sometimes we have no option but to use the foreign languages, because defined contribution plan, defined benefit plan is coming from the IFRS literature. Defined contribution plan is nothing but your provident fund scheme. Defined benefit plan is nothing but your gratuity scheme. For example, only I'm saying there can be other types of defined benefit plan. I'm just giving you 2 illustrations of this. Provident fund becomes a part of your salary every month. Accrual basis every month, along with your salary, pass journal entry for provident fund. Benefit plan, gratuity plan, we've already discussed. Give it to the employer. Give it to the employer. Give it to the actuary. He'll give a report. There is something called as multi-employment plan. We'll come to that later on because there's a disclosure requirement. There is something called as insured benefits. This is a very interesting thing because ideally speaking, we can think about health insurance. Suppose I am a senior management person today. I am going to retire in 2 years' time. The employer says, your present health insurance plan, which basically covers me, my family, and me and my family only. This will continue for 10 years after your employment also. You are 60, when you cross 60, up to the age of 70, this insurance plan will keep continuing. Which means that the company will still pay the health insurance policy, health insurance premium for this. Defined contribution plan, month-on-month basis, even though I am not officially an employee, it is a post-benefit employment plan. It's a long-term plan. I will still go ahead, because I'm still, I'll use the word again, contractually obliged to pay it to. Therefore, I will do this. Just like my normal insurance accounting today, I will do the same. The fact that the employee has left the company makes no difference to me, because contractually I have obliged to pay him this amount. The last part of it is termination benefits. See, this termination benefits can be in two types. One is very popular, what we all know as VRS scheme, voluntary retirement scheme, wherein the company says that certain set of people who have worked in the company for more than 20 years, if you all want, I will pay all 3 months or 6 months of salary. Take the salary and you need not come to the company after 3 months or after, whenever that scheme is in force. This is one type of termination benefit. Most popular is only that one. The other type of termination benefit is when we sort of fire employees. Nowadays, of course, many of you who have probably been aware of the startup scenario and all these startups in the Indian context will probably know that a lot of startups are laying off employees. Now the things have changed from just firing an employee and telling him do whatever you want. They actually, the HR department, I mean, for a long time, I did not know what the HR department does, because I have always had some problems with that. But anyway, the HR department today has got the task of making employees comfortable even at the time of termination, which means that they will tell them that, okay, you're terminated now, we'll pay you 6 months of salary, don't worry about it. We will help you to find another job. We will give you certain benefits for 3 or 4 months just to keep you, so that you don't lose hope that you'll get a job and keep you running, whatever it may be. They actually make an effort to make the employees comfortable, which all of this means that there is a cost involved. Those costs can also be factored into your termination benefits. Ideally speaking, those should not be more than 1 year, because one problem we have in Ind AS is that, or I'm not there in AS, but in Ind AS is that if it is beyond 1 year, we will have to start discounting it here. Thankfully, we don't have to do that mandatorily in AS. So most of these benefits may not spread beyond 1 year, but in case they do, we'll have to think about how to account for it, because it could be a prepaid expenditure. We can amortize over a period of time. So that's what we have to look at for termination benefits here. There are some exemptions given for level 2, level 3 companies and level 4 companies here. And entities whose average number of persons employed in there is 50 or more, which are, I told you about this thing, exemption is there for leave encashment, which are not vesting. You need not account for it. Termination benefits fall due for more than 12 months after the balance sheet date, again, not required here. Some exemptions have been given here. Post-employment defined benefit plans, the projected unit credit method has been mandated only for level 2, level 3, level 4, any other rational method. This goes back to the question which was asked to me earlier by some participants, saying that what happens if I don't, the cost is benefiting, I mean, the actual valuation cost is, high. See, what the standard is saying, what they're giving exemption is only other rational method. They are not saying don't get actual valuation report. They are saying that actually can use any other method. You can use an estimation method, for example. A simple Excel sheet will tell you what is the provision to be made here. You don't have to do PUC method. PUC is called as projected credit unit method, or PCU method it is called. There is a specific formula given for that. You have to do it in that formula. Similarly, for the less than 50 members, there is no discounting required here. And post-employment defined benefit plans, other rational method and other employed long-term employee benefits have also been given any other rational method. So if you look at it from the point of view of these enterprises, actually can give you a simple estimate of how much to provide for. He can also estimate actual gains and losses. He knows how much that dividend has come from the insurance company, how much of returns we have got. He knows that very well. So any other rational method only if you all are in this particular category of less than 50, more than 50. So this basically has completed the AS 15 on employee benefits, AS 15 revised on employee benefits. Now I'll quickly tell you all the management responsibility, the auditor responsibility here. Very popular from the auditor's point of view is not getting actual valuation report. I've already responded to the question. I think from the management's point of view, they should tell the auditor, they should inform the auditor what are all the employee benefits they have given, because many a time, we assume that it is only a part of what we see in that contract letter. From the auditor's point of view, sometimes, for example, say club memberships and all those things, those also are given not as a part of the letter, but they're giving sometimes out of the letter also. As far as the auditor is concerned, he knows that this is the salary structure, if I may use that word, of the company. They've got the structure, they've got this program. And for top management, they may probably have an ESOP scheme, they may have a club membership scheme, they may have a long-term, medical benefit scheme, health insurance beyond the term of employment. They may have all of these things. It is important, of course, from the auditor to test check this. But though this is not directly related to the audit, what we are seeing nowadays, in a few cases at least, is that many of these companies have not done a proper background check, background verification. They may have done it because the agency may have asked some, normal questions and the responses may have been normal, but it has turned out those employees turned out to be not those who appeared for the interview, or multiple, did not have the skill sets, the degrees were false. A lot of such issues have cropped in here. And those people, there was obviously a cost to send them away or terminate them. So this also has been a very frequent occurrence in quite a few cases in the Indian context also. Though we are not responsible as auditors for that particular aspect of employee benefits, because the management themselves will probably go and depend upon their background verification report. It will probably also give you all a little bit of a clue about the internal financial control. Though we only going to report on financial reporting, it gives you an overall idea of whether you have to create a provision for those things is something the management has to tell out. So the AS 15 revised responsibility of management is very, very clear. Please give the auditor every type of benefit which has been given to every type of employee. In case there are certain exceptions, please list them out also. As far as AS 16 on borrowing costs are concerned, I think all of us know this from the time we have been doing our CA. Certain borrowing costs which are qualifying assets can be capitalized. The rest have to be expensed out of the P&L account. The standard uses a word called as qualifying asset, and it says that qualifying asset, which is something which takes a substantial period of time to build. And by way of giving us a small hint, it says that anything beyond 12 months can be assumed to be substantial period of time. Though they also say that it's not necessary to have 12 months as a formula. If anything has taken 10 months to build and you feel it is substantial in nature, mainly in terms of costs, that can also be considered as a qualifying asset for the purpose of borrowing cost. This is the basic fundamental of the standard. Certain borrowing costs can be capitalized. The rest has to be expensed to the P&L account. The term qualifying asset, deeming provision seems to be about 12 months, but it is not a mandatory provision. If I am building something substantial in nature and it is costing quite a bit and it is done in 10 months of time also, there is every possibility that you can still call it as a qualifying asset, because no time, that the time month of 12 months given is only given as a representative number. It's not going to be this thing here. What are the borrowing costs? Interest and commitment charges on long-term, short-term borrowings. Amortization of discounts or premiums related to borrowings. Amortization of ancillary costs incurred in connection with arrangement of borrowings. Basically, brokers' commission also can be added to the borrowing costs, is what they say. finance charges in respect of assets acquired under finance leases. Exchange differences because of these borrowing costs. Now, if you look at, again, we will look at a more practical Indian context examples of loans. You've got, foreign currency loan, you've got rupee loan, you've got term loan, you've got working capital loan, you've got demand loan, you've got so many types of loans. Basically created by those banks only. But again, just to ensure that all of you all who are in touch with the present day, trend of having an app for everything, and they're talking about fintech and all those things, things have become very, very simple for us. At the same time, they create a plenty of accounting complications. I will give you all a very simple example just to explain what this is, why we are talking about this, and especially in the context of borrowing cost, and also in the context of borrowing also. Just a very simple example I'll give you. I'm using the word called simple because there is an app called as Simple, SIMPL, it's called. Many of you can try it, right? It's called SIMPL. It's now this new concept of what we call as BNPL, Buy Now, Pay Later, it's called. I do not know whether in the Indian context, BNPL will be successful because we have always been used to paying up on time. We don't want to, at least the majority of us, at least chartered accountants have not always have this in them to pay it up on time. So we don't require this BNPL concept at all. Now, this BNPL is a very interesting thing. There's something called as SIMPL, which is probably this BNPL. And I think they have tied up with a few of these agencies, some of the shops, maybe Swiggy also to a certain extent. I do not know, but I'm just telling you that what happens is that when you go on to the online and you want to purchase something, let us say from Swiggy, for example, at the time of payout, at the time of payment, it asks you a very simple question. Do you want to use SIMPL? And all of you all know this today, when we do it in a hurry, you may probably say yes. Why I'm telling this? Because it happened to me. I was ordering something and by mistake I said yes, and the payment went away. Not from my account, but from SIMPL. Now, I did not know who SIMPL was at all. Apparently, at some point of time, I've downloaded the app or I said yes to whatever it was online. But anyway, very simple transaction, 250 rupees went away. I got those items for 250 rupees without actually paying for it through this app called as SIMPL. There are quite a few apparently. Now, my concern was, how do I pay this person called SIMPL? I do not know who he is. He's just there sitting on my mobile phone. How do I pay him? He has not asked me for money. Should I pay him? It became a next question. Because is it my obligation to pay for him? Maybe I said yes, so I'm legally obliged to pay also. All these multiple questions cropped. This went to the next level of discussion, thoughts in my head, and I was wondering, what happens if I will not pay? Okay, as I said, I have clicked yes, so I have to pay, but what happens if I not pay? Nothing happened on that day of purchase. After 3 or 4 days, we got a message saying that, yeah, thank you for using, Simple, and you got time to pay within 30 days. In case you don't pay within 30 days, interest will be charged. So now we know what borrowing cost is. Up to 30 days is free of cost. 31st day, you have to charge interest. So that also will be a borrowing cost, is what I'm trying to tell you. Not only in classical term loan, rupee loans, this also becomes a, borrowing cost. Okay, I'll quickly answer a question from Binod Periwalji. He says that truck teller purchase payment made from borrowed funds, delivery received after 45 days. Can we capitalize interest for this 45 to 50 days time when it became put to use? Binodji, it is available for use, not put to use. So, payment made from borrowers and delivery received after 45 days means available for use. Don't worry about put to use concept now. Put to use will only accelerate your depreciation. So don't worry about put to use. As long as available for use, the moment you took delivery of the truck, start depreciation. Up to that date, capitalize the borrowing cost. No problem as far as AS 16 is there on that. Okay, so basically we know about this fact that directly purchase, those are capitalized. In case there are direct costs, term loan, for example, I have taken a term loan, I have purchased a machinery. matter khatam, no problem at all, because the term loan will go to the borrowing cost, capitalize the machinery. I don't have a specific term loan. I've got various bundle of loans. You will put weights for that and do what is called as capitalization rate. On that capitalization rate, you will do a borrowing cost, and that portion will be capitalized. And normally, what is expensed as per AS 16 is only a differential. What is not capitalized is expense. It goes by default principle. When do you commence it? When the borrowing costs are being incurred and activities necessary to prepare the asset are in progress. When do you suspend the borrowing cost? Extended period in which active development is interrupted. Again, you can see a very interesting word used here. Extended periods in which the active development is suspended. I will again go back to the default classification and say that I will assume that anything more than 1 year is extended period. So inactivity for 1 year can mean a cessation of borrowing costs. Again, please don't think of this as a formula. 8-10 months can also be a cessation. It depends. I won't say entity specific, but it is case specific. So don't think that it is mandatorily has to be 1 year. When do you stop borrowing costs? All the activities that prepare the qualifying asset for use are complete. When it is in parts, you do it in case the assets can be used separately. Those you can also capitalize it in parts. Say, for example, you look at a CNC machine. CNC machine you can't capitalize in parts because the computer software requires the hardware requires the software. But there can be a tool in the CNC machine. Already one is inside. You can have one more tool. Many of these CNC machine tools are quite costly. That you can capitalize separately. Need not have to link it with the CNC machine itself. So those options are there when you are doing this, borrowing cost in part. You will have to see how those assets are being used also. Can those assets be used independent of each other? This word becomes important. Independent of each other, not independent as separate assets by themselves, independent of each other, right? So that is important. Now, then you look at this capitalization in parts, then we will have to see what is to be done for the other part of this thing. As far as the disclosure is concerned, accounting policy allotment for borrowing costs, amount which has been capitalized during the period will also have to be disclosed separately. Now, because this is a session on 360 degrees, we spoke about annual report a bit. I also told you a little bit about disclosures a little bit earlier also. But I want to just put this all together and tell you all that. Again, I'm not telling this in a manner in which there's a violation or something. Disclosures, normally what we do, we give disclosures what has been specifically mentioned in the accounting standard to a large extent. The second type of disclosures we do are when somebody competitor, he is disclosing. That also we will disclose because he is doing it, so maybe it is somewhere they will also do it. Normally these two types of disclosures only happen in the Indian context. I think we should probably, while both are absolutely fine, there is absolutely no harm in doing both of those types of disclosures. I think it is time for us to look at, again, I'm pushing this upon the management, not upon the auditor here, because the auditor can only comment on what the management has been doing. Let us say that there is a borrowing cost, or I'll go back to a loan situation only. Let us assume that there is a loan. There has been a small default on that loan. See, when we look at from the auditing point of view, what we get in front of us, we don't get all these numbers. We'll get a bank statement, we'll get a bank reconciliation statement, we'll get a loan statement. May not exactly know that there is a default amount. It is up to the management to inform us that there's a default. Now, you are definitely going to ask me a question. Why will they say there's a default? Because they know that it's a Caro reporting issue also now. They know that it's a Caro reporting issue. So there's going to have multiple repercussions. So why will anybody in that sense tell you that oh, you know what I did in the month of October, I defaulted on one loan. And, it will bring back so many memories because ILFS started with the default only. The entire ILFS story commenced with the default only. So definitely you are going to ask me a question, why will anybody even tell this? And you all can also tell it is not the job of the auditor to find out this. So it works, both ways. The wind is blowing both the ways in this particular case. In case the management does not disclose it, is it necessary for the auditor to find it out? Again, no. The answer is no. But I am pushing this responsibility upon the management because you look at the sort of enterprises in which a large majority of the audience may probably be auditing. You will have family-owned enterprises. You will have holding company, subsidiary company. You will have some money which has been given there. Nobody will tell you what that money has been given for. He'll say trade advance, he will say, but actually it's a loan. We do not know about it. Actually, it will be a loan because trade advance has been sitting in that book for about 3 years now. What he actually gave was loan, but he did not tell you. It became a trade advance. So this is where I think we need to again look at it from the point of view of accounting standards, management, audit committee, all those things I told you all about. Ask the audit committee to let the management know whether this is a loan or whether it is really a trade advance. Why is the trade advance pending for 3 years? Why no action has happened on the other side? Why there's been no set-off entry? Many of these questions would obviously come in, right? And this is also linked, as I told you earlier, also with the related party transactions. This will happen only with related parties. You may have few trade receivables outside which are like this, but most of the time, you can take it from me that it will only be related parties. What is the borrower's, what is the management's responsibility here? What is the borrower's responsibility? What is the auditor's responsibility here? I think we know about the auditor's responsibility, but why I came to the disclosure part and wanted to tell you all of you all this is that it is the management who should be sensitized by the auditor, saying that it would be preferable in the long run to disclose everything than keeping on things and not disclosing them. I told her about default. I told her about loan default. Okay, that's a very large event, so maybe we should not worry about default because it can be negative also. Maybe the auditor also feels, why should I do this, and not disclose it, because it can turn out negative from many points of view. So, but still, in the right senses, if you look at it, it is the responsibility of the management to tell them that there has been a default. We are renegotiating the bank for restructuring. It is possible. That is where we are getting to in terms of disclosures. So I think after this program is over, all of you all should, many of you all who are probably going to be in audit, many of you have got clients who are, these typical small, medium enterprises and all those people, try to go and sensitize them and telling them that you need not, this is not Ind AS. You don't have to give everything in as per Ind AS. But in case there's anything substantial in those 28 or 29 accounting standards, which it is a responsibility of the management to give it, please ask them to give it. This is where the role of management comes into play here. Tomorrow morning, suppose they do not give it and you find out something wrong, always you can tell them I have asked it. So also one more thing which we should probably develop now is this skill set of documentation and communication. Put it into an email and keep it with you. These things, maybe you all are wondering why I am telling you. The reason why I am telling you all these things is because tomorrow morning, we do not know who is going to ask what question to us. It's a fact. I'm not trying to, over-amplify what is happening on the ground today. We do not know who's going to ask what to us. Many people are asking many questions today. You just put out an email telling them that this is what is. That is more than sufficient for the purpose of disclosure, documentation, everything. Audit committee also, I'll disclose a little bit about. I told you about that also. Push the blame on the audit committee. In fact, just to give you all a little bit of a example, which is slightly different. Again, I'm telling this only from the point of view of disclosure, and because that point becomes important. the financial statements by themselves will only give you numbers. How do you interpret those numbers? How do you understand those numbers? With what do you relate those numbers to? That becomes important. That is where disclosure comes. I will just tell you an example which puts all this together. Then we'll move on to the next one. There is a situation of a client wherein he had some problem with income tax people. And there was some demand which was, okay, I should not say demand was raised also. There was something which they went and settled with. They said, okay, I'll pay a higher tax. I'll pay some amount of money as tax or whatever it may be. And they did not want to make a provision in the books of account because they felt that it is not required. This happened somewhere in Bhopal or somewhere. And they are saying that, look, until I get a demand notice from the department, I'm not going to pay a tax or make a provision for tax. You look at the standard says that current and prior period taxes based on estimated amount which I expect to pay the department. These people apparently have made some expectation to the department. Or they've given some correspondence saying I'll pay this much or whatever. Very clear. So the auditor was in a quandary. He asked me what is to be done. I told him it's very clear. If they don't provide it for it, they're not complying with the standard. You have to put it in your report. Again, you know, that question of putting in the report, independence, all those questions came into play there. I told him, okay, if you don't want to do this, it doesn't matter. You tell them that go and give this to the audit committee. Let the audit committee decide this now. Tell them it will be a non-compliance with the standard if you don't provide for it. A. Second, in case it's not provided, what will be the repercussion in your audit report? Whether it be a disclaimer of opinion, whether it will be a qualified opinion, modified opinion, whether it will be KAM, or whether it will be EOM, whatever it will be. You decide that. Go and tell them. There is enough and more space in the audit report today. I told you earlier also. So please sensitize them that they should disclose information unless it is confidential information. That we'll also give it to them. You need not to disclose confidential information. There has been a question which I have been wanting to answer for long. I couldn't do. I think this is from Nitin. Nitin is basically talking about the fact that this is again about capitalization only, borrowing cost only. So it's relevant that I'm answering the question here. 2016, he says land was purchased. Land was registered in 2020. Land was registered in 2020. And his question is whether I can capitalize the borrowing cost from 2016 to 2020 because of the fact that, if I may probably go back to the previous schedule, borrowing costs are being incurred and activities that are necessary for intended use or sale are in progress. I'm assuming that all these things have been met in the land in which, Nitin sir has been. So when we're talking about activities, let us say that there was some development activity which had to happen in that land. Building had to come up there. That also has taken time. It took 3 years now, and because of nowadays we can always give the example of COVID now. Because of COVID, there's a delay of 2 years now, and now it has been capitalized. Absolutely no problem. In my opinion, yes, you can capitalize those costs. Unless the only reason when you will not capitalize this, because suppose the land building has come up in 2016 itself. You started using the building itself. They told them, "Acha, theek hai, doesn't matter, use the building, don't worry. Registration baad mein dekhenge." And registration happens in 2020. I think this available for use clause becomes important here, Nitin. What you should probably think of is that if I've got my entitlement to use the asset without waiting for the registration, you cannot capitalize because that day itself it is over. But if the registration is mandatory for me to use the asset, as happens in many cases, you'll have to wait. Those up to the 3 years gap, you can definitely capitalize it. Those 3 years you can definitely capitalize. There is a very interesting entry in the borrowing cost standard on what is called as forex borrowing cost. Slightly complicated, but I won't say complicated, but slightly unusual. But please hear me out because this example also flows from the standard itself. $10,000 US down 5%, 45 per dollar went up to 48 per dollar. Corresponding amount could have been borrowed in local currency at interest rate of 11% as on that particular date. So just look at the interplay here. We are talking about borrowing costs but there's an interplay of foreign exchange also here, because I've got rates. I've got 45, I've got 48, and I've got the fact that in case I had to borrow in the local currency, that number also is there. This AA16 is giving us a very interesting answer to this, and they are trying to say that interest, I've given the working also here. As I have told you all, I have already shared this with the organizers, so I can pick up this presentation from them also. There is a interplay between forex standard and interest borrowing cost standard here. I'll just explain this to you all very simple terms. I had two situations here. I had to pay interest at 48 rupees at 5%. I'm talking about conversion rate, 48 rupees. 5%, $10,000, I had to pay interest. My liability also increased because the dollar went up. My liability also increased by 30,000. The INR interest is only for the purpose of calculation, not for the purpose of accounting. INR interest I got at 49,500. The difference is 25,500. My total forex obligation is 30,000 plus 24,000. 30,000 increase in liability, 24,000 interest. Out of which I have classified 25,500 as borrowing cost. Actual borrowing cost is 24,000, which is the USD plus the INR one, which gives me a borrowing cost of 49,500 and a forex difference of 4,500 rupees or dollars, as the case may be. The forex difference is only a balancing figure here. So what the standard is actually saying is that in case there are forex borrowings and you have got an interest component of that, you also have availability for domestic borrowings. Benchmark the two and try and allocate between foreign exchange gains or losses and try between your foreign what I call as the foreign exchange gains and loss and borrowing costs here. Okay, so I have just seen that GVV Satyanarayana Garu is here. So good evening, sir. I'm a very senior chartered accountant, known to me for a very long time. Nice to know that he's also in part of the session here. So why this standard becomes important here for the purposes of your forex differences, that the accounting has happened in AS 18 itself. I don't have to worry about forex now at all. I don't have to worry about that. This is a default figure. I go there and do it there. There, the concept of integral, non-integral is there, but that doesn't matter to me at all because I've already pushed this from here, from AS 18. I push it to my borrowing cost, foreign borrowing cost. Slightly different example, and still many people have been wondering, why should I benchmark it with the Indian borrowing rate? Because I'm not going to borrow in Indian at all. It's an actual fact that my borrowing has never happened in India at all. In INR, my borrowing is not there at all. Why should I benchmark with the Indian rupee borrowing? But I think this is again a reason for this. The only reason I can think of for this is that because the foreign exchange differences standard did not specifically talk about those. It came on later on, that para 46, 46 came on later on. I thought they put in this clause before those paragraphs came in here. Capitalization of long-term foreign currency non-monetary items and creating those reserve and all. But they have allowed this to continue in your AS 18, so it remains there. So in case you've got a borrowing cost in foreign currency, you may have to benchmark it with the Indian borrowing rate. We can use the word called arm's length price, transfer pricing price and all those things, and get at that difference between these two for the purpose of your borrowing cost, total borrowing cost. AS 18 is the next we are going to take, related party disclosures. As I have already told you all about this earlier also, many people feel that related party transactions are dangerous. Related party transactions should not be entered into. Related party transactions are banned by Companies Act. None of it is true. We will have to accept the fact that in many clients whom we are auditing, and I'm assuming that all of us are in the same boat here, belong to the small and medium enterprises in which there definitely will be related parties. No two ways about it. There'll always be related parties. I am quite sure that many auditors who are in this audience have already noticed that during the last 2 years of COVID, there have been even more related party transactions have been happening. Because the bank is not giving you loan, bank itself is in a situation of not giving you loan. But we had to run the business. So a lot of loans from related parties have been taken in this COVID time. This is a problem only, no doubt about it. But I will repeat that the Standard Companies Act, SEBI, whoever it may be, does not prohibit related party transactions. All they are saying is about disclosure. So, and of course, the word called as arm's length comes into play. I always give this example. Suppose intercorporate deposit I am giving to others outside. I am charging others 10% as my interest. To a related party subsidiary company, I can give it probably at 8%, 8.5% maximum. I can give it discount. It's still at arm's length price. I cannot say, for example, give it at 3% or 4%. That will not meet that arm's length price transaction. That benchmark will not be there. So definitely, we will have to benchmark it with the best. When I say market rates, it can be near the market rates. So this is what I wanted to place in front of you all for related party transactions. So let me just take this question which has been asked from, okay, Murli Krishna Prasad Garu has asked this question saying that a commercial building was purchased by a company for 4 crores by taking 3 lakhs loan from bank at 12% interest per annum comes to 36 lakhs. Rental income is only rupees 12 lakhs. Please, whether the interest can be capitalized as there is no chance of adjusting the interest loss against any income. The loan was later repaid by introducing capital by the shareholders. Interest can be capitalized as there is no chance of adjusting that interest loss against any income. Okay. So his basic question is that I got rental income of 12 lakhs of rupees only, but my borrowing cost will be very, very high. It will, I can't set it off, and whether I'll be able to capitalize it. I think, to answer your question, Murli Krishna Prasad, don't worry about the income part of it here. I will still go by the standard. If you are saying commercial building, qualifying asset, more than 1 year, I'm assuming again, 1 year is not a formula, but assuming it's more than about 1 year's time. Qualifying asset, borrowing cost is there. Borrowing has been used for the purpose of the asset. Nothing prevents you from capitalizing. Nothing prevents you from capitalizing. Binod has asked a question which I'll answer once I finish the presentation of related party. He's talking about the auditor's responsibility in case of interest-free loan given. Applicable only for level 1 and level 2 entities. Level 3, level 4 entities is an exemption given here. Okay, don't worry about the scope and all those things. So who are these related parties? Holding company, subsidiary company, fellow subsidiary company, associates, joint ventures, individuals whose interest in the enterprise gives them control or significant influence, KMP, enterprises over which are able to exercise significant influence. So I think all of us by this time, all of us chartered accountants by this time, auditors by this time, have got a set of companies or set of entities, I would say, whom we definitely know to be related parties. Holding company, subsidiary company, fellow subsidiary company, joint venture, we all know, definitely. Associate, we all know, because that is there. 20%, 50% joint control, whatever it may be. We also know this concept of what is called as KMP. And for us, KMP means always CEO, CFO, company secretary, general manager, finance, all those people. If you extend that argument a little bit further, they are talking about enterprises over which the KMP also got significant influence. They also will be related parties. Even though this is only for the purpose of disclosure, the last part will again have to be proved. the theme of this program has always been, what is the management's view of responsibility towards these accounting standards? In the case of related party transactions, the responsibility of the management is immense, because they are the people who have to come out and tell us that these are related parties. We will not know. How will we know who's a related party? This is where the role of the auditor. Okay, we know what we are going to do. We're going to give a list to them and tell them that we're going to ask them for a list, and the list they give is what we assume to be related parties. We cannot go beyond that. Management is also responsible for this word called as significant influence. This cannot be a mathematical equation, though even India says 20%. You look at the concept of substance over form, look at the concept of fair value accounting, look at the concept of best-in-class disclosures. What will happen is that in case this significant influence has to be interpreted, significant influence can be interpreted only when it is proved. When it is proved is when it will be, it will be, what you can say, proved that there is significant influence. 20% may only mean that I've got 20% shareholding. I may not have significant influence. KMP can have significant influence. We recently got an example of a company in Kerala, for example. There was they had a CFO, or I think, or CEO, or a CFO, I think, yeah. Now, one of his relatives was working in a Samsung dealership in Cochin, I think. And this company wanted to gift mobile phones to employees who have performed very, very well in a particular year, or performed during the pandemic or whatever. And they had about, they had to buy about 100 mobile phones to give these people. 100 Samsung, all those things come, S29, S30, S40, all those things. Not normal phones, those smartphones as they are called. So what the CFO did, he called up his relative who's having the Samsung showroom and told them that this is your contract. Whenever we require a mobile phone, we'll tell you. Don't go anywhere else. He told the HR department, admin department, go to this person only, he'll give you a very good rate. Doesn't matter what the rate is. Significant influence is there, both over the company and on that mobile Samsung dealership. It will be a related party transaction. It will have to be disclosed. If you ask me, how is the auditor going to know? Auditor is not supposed to know about this. Auditor will not know about this. But I will tell you all about this interesting thing which happened in this conference also. We have always, the conference is supposed to be watching the watchmen and all those things. And one of the questions which asked me by the panel member was the fact that he asked me this old discussion about, is the auditor a bloodhound or a watchdog, and all those things came up. Kingston Cotton Mills case, 1875, and all those things. I told him it's time for us to change the definition of, think of a new name for the auditor. And he asked me, can you think of a name and tell me right now? I told him the auditor is like a third umpire. Though this IPL season is going on, I know that it's nothing but the third umpire. Two people are already doing something. I only have to pass my judgment. The company and the accounts are there. I have to pass my judgment on. That's why I'm a third umpire. So in the case of RPT transactions, auditor's role is only going to be limited. I can benchmark with what I had last year. I can benchmark the related party transactions of last year and say, oh, this new person has come as related party. Who is he? What is he? And all those things. But ab initio, it is impossible for an auditor to make out. That is why management responsibility becomes doubly more in the case of related party transactions. Okay, so the next question all of you are going to definitely ask me. There was one related party transaction that happened like this mobile phone business. Company did not disclose. Auditor did not see. Auditor could not see. I should not say did not see. Auditor could not see. What happens? That year, nothing can be done. But if it is discovered later on, you may probably have to give a disclosure saying that he was also a related party last year. It is always better to disclose with when that RPT transaction got into instead of not disclosing at all. That would also be a way of looking at it. Okay, then of course we have Who are not related parties? 2 companies under a common director, single customer, supplier, distributor. But all this has to be proved, incidentally. Just because he's a single customer, that word called significant influence will still hold good. If there is significant influence, definitely he'll be a related party. Intra-group transactions, anyhow, we eliminated in consolidation, so that will not come into the picture here. And they have given a general rule here saying that they will be related parties if they've got the ability to control the other party or exercise significant influence over the other party in making financial operating decisions. Now, what this standard has done is that for the purpose of control, they have used something called as 50% of voting power, control over the board of directors, substantial interest in voting power, and the power to direct by statute or agreement the financial operating enterprise of the enterprise. Voting power, to a certain extent, I will agree. It is okay because you call for a board meeting. Easily we can make out voting power. Who's got 50%, who's got majority, we can make out. Maybe board of directors also same. But operating and financial policies may be difficult because this is not mathematical. This is non-mathematical. 50% of voting power, board I can count. This is a mathematical equation. Not this operating and financial policies. Suppose a person has got control over operating and financial policies, influence is there, he could definitely be considered to be a related party. We will have to disclose this, definitely have to disclose it. Then the concept of significant influence, participating in financial and operating policies, not controlling, but only participating. Small definition of who's a relative. 20% or more of voting power, it is deemed to be a related party. Now, here I would just like to pause for a moment and tell you all that, I mean, just to put you all in perspective, in Ind AS also, Ind AS does not talk about 50% for control, but talks about 20% for influence. This is what is called as a deeming fiction, which means that if I have got 20%, it is assumed that I have got significant influence. I will also add in a sentence here saying that unless I am able to prove otherwise, which means that I have got 20%, another person has got 80%. I can prove through, let us say, board meetings and all those things that I do not have influence because the other person will anyhow consolidate. But I have absolutely no influence. Participation in policy making is what the word used for significant influence. Participation means I just go there and participate. I don't contribute at all. To be on the safe side, you can say it's a related party. No problem at all. But in case you want to really prove it, you all should know that just because I hold 20% does not automatically mean that I'm a related party. KMP, we already know about this. The related party issue has always been about arm's length. Now, I gave you a few examples also about arm's length, but I think we need to also spend a bit of time on this because, as I told you, the focus or the responsibility of the management in the case of RPT is immense. What the auditor can do is that when he looks at, say, for example, eliminations during the time of consolidation, he can look at what those transactions are. You will probably get an idea of whether this was related party transactions or not. Arm's length, all of us are very familiar with this word. The concept of arm's length, the word called as arm's length, is very difficult to prove. Many of you who have probably had some experience in transfer pricing will agree with me when I'm saying that it has become impossible to establish an arm's length in transfer pricing. There are always adjustments being made. But be that as it may, the standard says that it always has to be at arm's length price, which means that invariably look at what the market is prepared to pay. It could be case specific. It could be entity specific also, because entities can have a certain criteria for related party transactions. Nowadays, of course, related party transactions are becoming part of the board resolution or audit committee and all. They say you cannot go beyond a certain level for related party transactions. They take budgets for all the RPTs. Many companies take budgets for related party transactions. 1 crore per related party it cannot cross. They have these various schemes. Disclosures are name of the related party, nature of the related party, where control exists, irrespective of whether there have not been transactions. So please don't think that only if there's a transaction I have to disclose. Name is there, transactions are separate. So there are 2 types of disclosures here. One is the name of the related party. Who is the holding company, subsidiary company, joint venture, associate, CFO, CEO, company secretary, GM finance, whoever it may be. Significant influence, trader, sole proprietor, supplier, all can be significant influence, all can be related parties. The second level of disclosure is actual transactions which have happened. I've identified 25 people. All transactions are not there with all the people. There are only transactions with 10 people. That will be the secondary set of disclosures. What do you disclose? The name of the person, description of the relationship, nature of transactions, volume of transactions, that's an appropriate proportion. All these disclosures are there. Now, this, I think all of you have already seen many of the related party disclosures. But again, I will go back and give you all a little bit of a hint, shall I say, about why these disclosures are becoming important. Just look at the last bullet point here. Amounts written off or written back in the period in respect of debts due from related parties. Specific disclosure has been given. I have not found this in many annual reports. I have not found this in many smaller company reports also, which I have had the opportunity of seeing. Amounts written off or written back in the period in which debts due or from the related parties, which means that I have given a certain advance, I have given a certain loan to a related party, not come in here, written it off, you will have to give a separate disclosure. Normally, this is not being given because people have not read this paragraph completely. It is not only about the fact that I have given a loan to the subsidiary company, it's also a fact that he has not repaid it and I have written it off. That disclosure has to come separately. Sometimes I'll convert the outstanding balance to equity also. That also will come by way of a disclosure. Whatever, see, I always give this example for disclosures and the Ind AS, of course, but participants can take a small cue for AS also from this. Because when I keep on talking about disclosures, many people ask this question. Okay, sir, we understand disclosures are very, very important. What should we disclose? What is significant? What is important? How do we commence? What do we do? Many of these people have got these disclosure problems. And I know that many of the participants will also agree with me when we say that the days of looking at Infosys and Wipro disclosures are over now. You can use that as a template if you want. For example, for those of you who are interested, Caro 2022, TCS Caro has already come out in their website. You can use it as a basis because this Caro 2022 is a very dangerous document if you ask me. I do not know with what confidence you're going to sign the document. But TCS doesn't have so many clauses, but we could have situations of having those clauses in many of the enterprises we are already. But anyway, so if you want, you can use that TCS as a template for the purpose of Caro disclosures. The last one will never be written off, will never be disclosed with the company. But we have to insist, we have to ask them for this because that is where the role of management, audit committee and auditor is becoming increasingly day by day important. Not only is it important, it is also very critical for the company's corporate governance and all those practices. Those also are impacted because of this also. You can aggregate. You don't have to do separate line item for each transaction. Aggregate those transactions. Aggregate those transactions related party wise. Don't combine related parties. Aggregate the transactions. Don't aggregate the related parties. This is what we're trying to say here. Before we move on to intangible assets, I will answer this question which has been asked by Vinod Perivalji. He says that in the case of related parties, if loans have been taken from directors without interest, What are the obligations in the company and disclosures required in auditor's duty? Very good question, Biraj. So, of course, in India, you can't do this, but I'm not talking about India here. So he's basically said that loan has been given without interest. What else has he said? What are the, okay, only without interest. What are the obligations for the auditor and what are the disclosures required? I think, Vinod, what I would suggest you should probably do is first ask if there is any, what are the clauses of the loan agreement? I think that's the first thing I'll ask as an auditor, because I want to look at a few things there. What I want to look at is there a repayment schedule which has been promised? Or is it adjusted from the salary itself? Is there a clause which says that in case it is not repaid, I'll issue equity shares converted to capital? All these clauses are normally there in most of the loan agreements. That's why I'm asking this question. So it is a fact that, okay, he has been given interest free. That means he doesn't have to pay interest, but he still has to pay the principal. Is there a schedule for that? Yes or no? In case yes, is the schedule being adhered to? It will be adhered to because most of the time it is a deduction from your salary. The other part of the situation here is that what is the auditor's report here? The auditor's report or the auditor's responsibility here is very minimal, because as long as that is being met, he does not do anything at all. No need for mentioning the report, no need for fair valuing the interest on the loan, nothing at all. Just keep it as a normal situation of a related party transaction. Suppose it is converted to equity later on. You will again have the compliance requirements. Have you filed, inform the ROC? Have you filed that particular ADT form? Whatever it may be, all those things, compliance will be there. That's more a compliance-related situation. But still, the fact remains that it has been an interest-free loan given and converted to capital means there is always this disclosure saying that these are the terms of this loan agreement. It is supposed to be paid back in this time. It has not been paid back this time. The agreement says that in May 2022, if nothing has come, shares can be issued to convert it into share capital. So progressively, this thing has become a problem. So therefore, we can progressively create this and ensure that at least from the accounting point of view, there's no problem as far as accounting is concerned. And that is the reason why accounting standards are there. They want to ensure that too much of a, I won't say difference in practice, but too many options are not given to the auditor or the accountant to account for one particular type of transaction. Provisions can only be one type of transaction. You can't have multiple provision standards. So you can't give many options. One of the things which you've always had in AS, one of the criticisms we have always had in AS is that there are too many options in the standard. But strictly speaking, okay, not too many options, but many people felt that you're not mandating it, you're not saying it's mandatory, but giving options. So anyway, all those problems cropped up for your related party transactions. The company or the entity, as I said, they'll have one template. They will say, okay, these are my related parties. As an auditor, you will definitely ask more questions. You can ask them, why is no change in the related party? Has it become a new related party? What is the basis of the related parties in transaction? All these things are a part of your questions which will have to be asked. So let us assume that the management gives it. I think you should take it in good faith. If he says he has got 20 related parties, unless you have got absolute certainty about it, I do not think you can even suggest a 20% related party, because you need to have evidence, you need to have proof, you need to go and say that yes, this is a related party because of 1, 2, 3, 4, 5 reasons. Otherwise, it is absolutely okay. I am not giving a break because I wanted to continue and complete it. I hope it is okay. But in case any of you want a break, please let me know. I thought if I can continue, there are only 2 more standards left. We can complete, take up the questions and close it, But if any of you want a break, you all can take a break and come back. Or if you really want me to stop, I can also stop. I'll leave it to you. Sir.
Your wish, sir.
My wish, okay. I would like to continue, but I just thought I will. You're okay? No problem. No, if I continue.
Continue.
Okay. All right. So we now have to go to the next part, which is intangible assets. This standard is very interesting. And I said, okay, no need for breaks. So they're saying, okay, fine, good. This is a very interesting standard, especially in the present day in which we are. So many startups are coming up. Every company, every city has got a startup now. Startups are all based on app. Nowadays, everybody's on the phone, app. Intangible assets are being created like mad. This standard becomes very, very important. Now, the standard per se is actually very, very simple. The standard per se is actually very, very simple. Again, if you go back to the Ind AS, well, there are some differences, but we're going to ignore all of that for the present now. Basically, if you look at it from the point of view of an accounting standard, we know that there are tangible assets. We know that there are now intangible assets. The use of the word tangible means that we're able to see it. We cannot touch and feel it. We can only see it. In case we're able to touch and feel it, it becomes property, plant and equipment or investment property, all those things. But I will say property, plant and equipment because investment property, there's a different context in the AS world at least. The definition given in AS 26 is that intangible asset is an identifiable non-monetary asset without physical substance, held for use in the production of supply of goods or services, for rental to others, or for admin purposes. The only thing they have not added in the definition is that future economic benefits are possible. The only thing they have missed out, that also they could have added it, but in a more comprehensive and complete definition. Now today, the situation is there, wherein suppose you ask any person, can you give me one example of intangible asset? I am quite sure that 80% will respond saying goodwill. Because right from our CA intermediate days, we've been taught this. Intangible asset means goodwill. We know that there are other intangible assets also. But inculcated into our mind is the fact that goodwill is an intangible asset. It meets the definition of an intangible asset because it is non-monetary. This cannot be converted into cash immediately. It does not have a physical substance. You cannot touch and feel goodwill. You can only see it. You can't identify it. Sorry, I won't even say see it. Identify it. Okay, identification and see may be the same. It is held for use in the purpose of production of goods or services. Because of the goodwill, I got a brand name. Therefore, I can use that. It can also be used for rental to others or for admin purposes. So as I've told you all, the most popular example we get is goodwill. And nowadays, of course, we all know that we also have intangible assets like trademarks, patents, brands, all those things. I told you, goodwill, customer list, all these things are examples of intangible assets. (26) says 3 criteria for recognizing intangible assets: identifiability, control, and what I spoke to you in the definition, future economic benefits. Future economic benefits is probability only. I should not actually get it. I need not get any economic benefit. Still will mean an intangible assets. So we know the popular things, all these things. List. When Facebook acquired WhatsApp for $19 billion or whatever it may be, that huge figure, why would they pay $19 billion for WhatsApp, which had 50 employees and minimal revenues? Yes, software also will be intangible asset. That is just in response to the question of Murali Krishna Bhattapati. Yeah, it is an intangible asset. Why did Facebook pay $19 billion for WhatsApp? Because they wanted the list of customers of WhatsApp, customer list. They wanted them to get onto Facebook and all those things. That is the reason why they paid so much of money. Customers can also be an intangible asset. The standard says that there are three principal elements which should be there for asset to be classified as intangible asset. Identifiability, control, future economic benefit. So what I'm going to do is that for the purpose of this discussion, only for the purpose of this discussion, I'm going to give a new example for intangible asset. I'm going to give an example which normally people do not give as an example for an intangible asset at least. So let us say that the government of India is planning to set up a new airport. In, since I'm in Bangalore, there are a couple of places already there. Most of the cities in city. Any place can quickly reply and tell me. Otherwise, I will put any city. Is my internet connection unstable? That's fine. Okay. No, I don't see any person responding. Oh, Darjeeling. Rinku Gupta said Darjeeling. Thank you very much. Okay. Darjeeling is a brilliant example. Nice place also. New airport coming up in Darjeeling. Government of India said Darjeeling new airport is going to come out. Nice. It will probably take some time. It may probably take 2-3 years. Jewar, Noida. Okay, I'll use Darjeeling. Okay. Now, they have given the plan. Airport is, I'm assuming that the airport construction is going to come up in some time. Plan is ready. Everything is there. Now, according to the Airport Authority of India, every person or every airline which is wanting to operate to Darjeeling, it's not to Darjeeling, to any city, but since the example of Darjeeling was given, I use that as an example. Suppose you want to operate to an aircraft to Darjeeling, you should apply for and get what is called as landing rights. You should apply for and get what is called as landing rights. So tomorrow morning, suppose the government announces in the newspaper that new airport proposed in Darjeeling, all your popular people, Indigo, Air Vistara, all these people, what they will do, they will immediately apply for landing rights. Please remember that the airport is going to come up only after 2 or 3 years. It is not going to come up immediately. You cannot take a plane and fly tomorrow morning. Lot of permissions required. ATC is a separate problem by itself. ATC required some international approvals also. But anyway, all that is there. What Indigo does? Okay, I'll not say Indigo because some people, many of you don't like Indigo, I know. But I'll take Air Vistara. What Air Vistara does is that they will immediately apply for landing rights in Darjeeling. Airport landing rights for 2 aircraft, one in the morning, one in the evening, to land and take off in Darjeeling. They will spend a substantial amount of money on that because landing rights are costly. Let us say that they pay 5 crores of rupees for 2 landing slots per day in Darjeeling airport, which is going to come up in 2-3 years' time. Vistara has applied for landing rights without even knowing whether they will actually fly an aircraft to Darjeeling or not. Because that depends upon the traffic in Darjeeling, how many flights is Indigo going to do, what is the pricing. From Darjeeling, where will we go on the flight? Or do we have a connection flight to abroad, international connection? All those questions will be substantially answered only later on. Indigo does not want to miss, Air Vistara does not want to miss the opportunity. They anyway apply for these landing rights and they get them also. Look at the 3 criteria on the screen. Identifiability, control, future economic benefits. those landing rights can classify as an intangible asset because they meet all the three criteria mentioned, which you are seeing on the screen right now. Identifiability, yes, I'm able to identify the fact that yes, there is a landing right. I may probably have, an agreement also with it. Control, definitely there. I need not fly an aircraft. I can sell it to Indigo myself later on. Suppose Indigo has bought only 2 landing rights and they want 4. I'll tell them, okay, I'll sell it to you. I don't want to operate my aircraft. You pay me 10 crores of rupees, I'll sell it to you. I've got control. Please remember this word called as control. Many people have got this problem with this word called as, they say, what is control? There is no way control can be defined. I have always maintained that control cannot be defined. It can only be demonstrated. You take any concept of control for consolidation also. How do you say you have a control over a company? You're able to demonstrate it. 50% may mean nothing. Unless you demonstrate control, control is not there. I am able to control those landing rates. If I want, I can fly aircraft. If I want, I can sell it. If I want, I can rent it out. If I want, I can do nothing also. I can just sit on those landing rates. Nothing I need to do. I can wait for the prices to go up and sell it after 5 years also. Definitely I've got control because I'm able to demonstrate my control. Future economic benefits are definitely going to be there. Yeah, either I can sell it or I can actually make my planes land and take off from there, which means I get passenger revenue. Slightly different example, but a very relevant example for what constitutes an intangible asset. Identifiability, control, future economic benefits should be possible. I won't say possible, I'll say probable. Okay, this is a question I'm going to ask all of you, just to keep all of you interested. All of you know what this is. This is the logo of the ICA. Can this logo of ICA be, considered to be intangible asset in the books of ICA? Only as an academic discussion, please don't get me wrong in any other manner. ICA has got this logo. Identifiability, control, future economic benefits are all the three met in this. Balasubramanian Vishwanathan sir has said no. Can you identify with the ICA logo or you can just only see it? I think most of the people will only say I'm able to see it. I'm not able to identify with it. Control. Does ICA have got control over the logo? I think to a certain extent, yes, they may have control. Future economic benefits based on the logo, I am not sure. They cannot sell the logo. They cannot rent the logo. They cannot use the logo for any other purpose. Not meant for commercial sale. Correct. Raidu sir is saying all trademarks. Trademarks is slightly different. Trademarks, this is only a question of a logo. Trademark, I actually have in the trademark, I have a commercial license for something, if I may use the word commercial license. There is an economic benefit I'll definitely get for that. I've got control. I can sell the trademark also. You all can probably come and say, okay, ICA can sell the logo. I don't think they can sell the logo because it's their logo, internally generated, right? So they can't sell that. So I just put it as a matter of, just to keep all of your interest. Not that ICA is going to do it at all, but I just thought I should put this as a, just to keep your interest in this intangible asset. But landing rights is a very good example for intangible assets. The standard says that accounting always at cost. One of the main differences between AS 26 and your Ind AS is also the fact that subsequently there it can be at fair value. Here it is always at cost only. AS does not give the option of fair valuation for intangible assets. It is probable that future economic benefits will flow to the enterprise. The cost can be measured reliably. Identifiability, control, future economic benefits is one part of it. Accounting is always at cost only, and it is probable that we will get future economic benefits. If this is met there, then you can identify or account for this at cost. Account for it at cost means I will use a slightly different word. I'll use transaction cost. See, because we need to be a little bit careful about these intangible assets. Normally, I gave the example of landing rights because it's slightly different. Trademarks, patents can all be purchased. There's a cost involved. AS26 says, yeah, I know that, but it is only going to be at cost only. Whatever is the cost you're going to take, only that will be your cost. Government grant given free of cost is a very good example to give, and this discussion becomes all the more important in in the intangible assets sphere also. The same landing rights in Darjeeling Airport. I told you all Air Vistara is paying 5 crores of rupees for it. Indigo is paying 5 crores of rupees for it. Even though the government has privatized Air India, suppose they say that for Indian Airlines it is free of cost, which means that Indian Airlines can land 2 aircraft and those 2 aircraft and take off from Darjeeling Airport free of cost. Others have to pay 5 crores of rupees. The standard says that if it is an intangible asset, if it is being provided free of cost, record it at nominal value. No, record it at nominal value. They have not used the word called as fair value, which is their part of your Ind AS 38. They only said nominal value, which means that Indian Airlines in their books of account can record this landing right in Darjeeling Airport at 1 rupee. Just 1 rupee. They can sell it for 10 crores of rupees tomorrow. Does not really matter. We are talking about the initial accounting here. Initial accounting always at cost only. But in the case of government grants, in particular, they are saying that because it is free of cost, it may be done, it should be done at nominal value. What is the nominal value? It is completely up to the enterprise to decide what is that monetary value. Murali Krishna sir has again asked a question whether monetary outlay necessary attribute of intangible assets. I mean, free of cost, I've already told you what is to be done. You'll give it at nominal value. But yes, I would think that if I am going to get a future economic benefits, there has to be some monetary outlay right now. I think both are interlinked. It may not be a necessary attribute, but it is definitely what is happening. Because unless I put in something here, the economic benefits may not come to me. I think that is what is important to understand from the point of view of this thing. Okay. Internally generated is a very important aspect for intangible assets. Goodwill is not recognized. Internally generated goodwill is not recognized. Other intangible assets have been broken up into 3 phases: research phase, development phase, and post-development maintenance phase. I will only speak about this through an example. Because I told you all earlier also, startups, all these things are coming up today. Everybody seems to be having some sort of a fintech idea. And there's no doubt about it also that these fintech companies have really changed. Many of these companies have changed the way in which we are doing our normal day-to-day jobs. This is something which we definitely have to accept. There's no doubt about it. I mean, you can really go out of the house today and probably travel also without having to have any cash at all. They have done it in such a nice manner. And in case you do require cash, also there are options to get cash, there are a lot of things that. So, I mean, that's a thing which we all have to really appreciate. A lot of things are happening there. All your Paytms and all those things, apart from the stock market price, Paytm as an app is quite useful. For example, Phone Pay, which I find to be very useful. And it's very, very nice to use, simple to use also. But I'll come to it from the point of view of these 3 phases. Now, say, for example, all of you are very popular with Tally. All of you are experts on Tally, I'm quite sure. Tally Prime, Tally GST, reconciliation, everything is done nowadays. Tally is one of the best boons which have been given to chartered accountant by Bharat Goenkaji. We've done a lot of work on Tally. All of you, without Tally, I think many of us will suffer in our day-to-day accounting, day-to-day life also. Now, think of this from the point of Tally itself. the source code for Tally, or the so-called what we can probably call technical know-how for Tally, even though it is internal, it is intangible, because you can identify it, you can, control it, and you can also get economic benefits. I'm talking about the software. Even though it is internally generated, it can still, we can call, let us call it as technology. That can be intangible asset. But suppose Tally is going to say that because I'm so famous as Tally, I've got 20 million or 30 million users all across the country on Tally Prime. I've got a lot of goodwill. I want to recognize the goodwill as an intangible asset. Goodwill, please remember, why are we calling it as goodwill and consolidation? Because normally goodwill occurs only at the time of an acquisition, merger, amalgamation. Goodwill may not necessarily come at the time of an internal generation. So Tally may think they have a goodwill. It may be true also, but they cannot account for it. Look at other intangible assets. I'll give you an example from the institutes, from not institute, but from our own chartered accountants, this thing. Since we spoke about all this fintech and all those things. You know about all these companies called as Cred and all these things, right? So suppose you have developed an app. Suppose any of you develop an app wherein you all are going to make it very simple for chartered accountants to do compliance, which means that the app will remind a chartered accountant or an auditor on what day, what he has to do, when he has to do, for which client he has to do. Very far-fetched idea, but still practicable idea. Let us say that this is becoming a very important need. As they say, if you want to build a good startup company or build company itself now, look at what you want to disrupt. You all are fed up with so many compliances. Caro 2022 is going to come, then you have some new thing on IFC, then you have got GST, which do not know what it is. Even today, nobody knows what GST is. I keep on saying this, but people will feel that there is a lot of doubt in the statement. Many of you may be experts on GST. I'm not saying no at all, but at least I do not know. My problem has always been that I know only 70% of GST law. The officer knows only about 60% of GST law. How can we get an assessment done? Very difficult. So suppose you develop an app, all of you all put together, develop an app. At the click of a button, chartered accountant, auditor gets to know today what compliance he has to do, which compliance he has to do, which client is there. This app development can be broken into 3 stages. The research stage comes first. Research stage means the chartered accountant, the auditor is thinking. Okay, I won't say auditor now, I'll say the company is thinking. The company which you have formed is thinking. Okay, we want to develop an app. This will be the features of the app. These will be the users of the app. These are the benefits which the app will give to people. I expect so many chartered accountants to sign up for this app. I've got a free model, I've got a subscriber model. I want to have that. All this is research phase. You don't have a website, you not developed the app, just you thought about it. You have a business plan. You know how much of money you're going to raise. So all that is there in one document. Research phase. Research phase, no intangible asset, expensive stuff. Development phase. Stage 2. Development phase, you actually start building the app and seeing that it goes live in some time. They use the word called go live. Go live means you are building the app, getting the benefits in the app, done a number of test cases, sent it out to so many chartered accountants, got their feedback, rectified the app, put out a paid model, put out a free model. All this has developed. Go live means the app can actually be downloaded on the App Store. The definition of this thing is it can be downloaded on the go live means it can be downloaded on the App Store or Google Play, wherever it is, Play Store. Development phase can be intangible assets, says the standard. AS 26 says that. development phase can be intangible asset. In fact, I would think the development stage should be an intangible asset, because look at all those requirements there. Look at what are the basic identifiability, control, economic benefit. Can I identify this app? No, yes, I can, because I'm able to see and I'm able to download it. Do I have control? Absolutely yes, because I can add features here. I can link it with my bank account. I can link it with Razorpay. I can do it with international bank accounts. I can do a lot of stuff. Development phase, that is capitalized. Once the app has been developed, go live has happened, and the commercial, when I say commercial, I mean both the rolled out, the subscription plan and the free plan have been rolled out, it becomes post-development maintenance phase. As per AS 26, research phase expensed, development phase intangible asset, post-development maintenance phase also expensed, which basically means to say that only your development phase expenditure can be capitalized. Development phase expenditure can be taken to mean all those expenditures which have been incurred. We use something called as proof of concept, POC. You develop the app, you forgot the research phase. Research phase is done, forget it now. It's over. You thought about what is to be done, now you've actually implemented it. Development phase capitalized, post-development maintenance phase will be expensed off. Subsequent accounting is also costless depreciation. Useful life will be amortized, or the amortization has to happen over the useful life. In case the company is not able to determine what is useful life, 10 years from the date when it is available for use. AFU means available for use. And the standard says that you have to review your useful life every single year. It's very important for us to understand a couple of things in this. One is that I cannot say I don't know what is useful life. Again, you can do this in Ind AS. You can do that in AS. Because the standard itself is saying that, okay, you don't know the useful life, I'll tell you it's 10 years. This 10 years also is coming from goodwill only, 10 years as per Income Tax Act, amortization. That's where this has come from. Standard gives you the option and says, okay, you don't want to go for 10 years, fine, no problem. Decide what is useful life you want. A substantial degree of difference can be noticed between this standard and your property planning. In the Indian context, again, I'm saying. I have got a schedule in the Companies Act which tells me what are my estimated or useful lives which will normally not be different. That's what Schedule 2 says. Useful lives which will normally not be different means if I am the company, I will say somebody has already taken the trouble of putting useful life. Why should I break my head about it? Especially for property planning, but also for intangible assets. But by saying that useful life amortization here, the standard is giving us the opportunity to have a different useful life from that given in the Companies Act, provided this is reviewed every year. Why is it reviewed every year? Because impairment test also has to happen every year. If there is a debit for an impairment loss, there is a 99% chance that useful life would have also changed. That is why the standard is saying it will be reviewed every year. Sorry. I've already told you about disclosure here, the gross carrying amount beginning and end of the period. So I told you all about this easy way to do disclosures. I actually did not complete that discussion there. Opening balance, closing balance, all of us know. You can use this disclosure guide, or not guide, but tip I'm giving you for almost all the disclosures required in AS. You have an opening balance. You have transactions during the year, additions, purchases, sales, deletions, all those things. That gives you a closing balance. Pretty simple. Forget the opening balance, forget the closing balance. For whatever has happened during the year, additions, deletions, disposals, water transfers, all those things, just write a small 1 line or 2 lines about those things. I'm just giving you a different way to approach disclosure, that's all. Write a small line about one or 2 lines about each of those activities. The company purchased assets worth this much. The company sold assets worth this much at a loss of this much, profit of this much. The company depreciated as per the last year's depreciation policy. That is nothing but a disclosure required by accounting standards. Giving an explanation of the transactions which has happened during the year, that is what a disclosure is all about. Basic disclosure. There'll be other disclosures, obviously will be there, but we'll have to see how that works out. In case your amortization goes beyond 10 years, again, you can see here that the standard is not mandating you to 10 years, 10 years, 10 years. Definitely, they're not saying this, right? The other part is if it is about 10 years, please give a disclosure. Again, I told you about this requirement for disclosure. Whenever you all feel that we are going away from the standard, please give a disclosure. This is a very important tip which all of you all should probably think of, because opening balance, closing balance, all that I told you, but again, whenever there is a change, whenever you feel that there is a small change in the amounts, useful lives, give a disclosure. Even though I told you that R&D expenditure can be capitalized, I should remove the R in this. Only D expenditure can be capitalized because research fee is invariably put to your expense account only and expensed off. That also will have to be given as a disclosure. The next standard we're going to talk about is impairment of assets. Just give me a minute, please. I will have to look at this presentation because I think it's changed. Yeah, I think it's okay. Yeah, it's okay. So this impairment of assets standard is again something very, very important from same thing, is it? Yeah, okay, same thing. Yeah, great. Okay, this is a very important standard, especially in the present day. We are talking about post-COVID. So much of impairment has happened. So much of impairment could have happened. So much of impairment would have happened also, I'm saying. Whether those impairment losses have been actually captured, properly accounted, whether any impairments have been left out, all these things we'll have to worry about. I'm going to give you all, as usual, a few placeholders before we get to the standard itself. Again, a very important standard from the management point of view. For a moment, please go back and look at what an auditor will do. For fixed assets, he only has a Caro checklist. The Caro checklist says that have there's been a physical verification during the year, any differences notice of such physical verification, number one. Second, present day and age, the present Caro 2022, he would say that any revaluation in excess of a certain thing which is there, but the title deeds are name of the company. All this article clerks will take checklist and ticket. One of the major deficiencies, or I won't say deficiency, one of the major missing items in Caro, even Caro 2022, is after the clause about title deeds, after the clause about revaluation, they should have put one clause saying that, was there any impairment during the year? That clause is not there now. Because that clause is not there, the article clerk is not going to ask that question. Because the article clerk is not going to ask that question, the question will never be answered. The company may be having some property in Jammu and Kashmir, not been used for the last 2 years. Maybe it is not there, the building is not there itself, because what is happening in Jammu and Kashmir? We do not know. Auditor will not know. He is not going there every year, no. Very, very important standard from the management point of view. Impairment of assets not there in CARO also. Auditor may omit asking the question. You will have to tell the management that please give me a program for impairment. Please give me a program for impairment. What are your identification parts for impairment? See, I told you about COVID, because COVID, we know the factory is not opening, the restaurant is not open, restaurant is closed, no customers are coming in. We all know that. External indicators of impairment. Internal can also be there. Internal can also be there. Anyway, so this is a standard which puts the responsibility back on the management. Recovering amount, if the carrying amount of the asset is more than the recoverable value, the recoverable value has been defined to be higher of value in use minus your net selling price. The standard does not use the word called as fair value. Please be aware of that. That becomes a value in, that becomes your impairment. And value in use has been described to be the present value of future cash flows. Basically, valuation attributed to that particular fixed asset or property, plant and equipment. Carrying value is more than the recoverable value. There is an impairment loss. Carrying value is 500,000 rupees. Net selling price is 600,000 rupees. No problem, no impairment. VIU also, that is 600,000 rupees. No VIU, no impairment. Carrying value 500,000 rupees, 5 lakhs of rupees. Net selling value 3 lakhs of rupees, definite impairment. VIU 3,50,000 rupees, definite impairment. Value in use means present cash flow discounting all those things. Sorry, future cash flow discounting and all those things. Carrying value is more than the recoverable value, which is the higher of net selling price in VIU. There's an impairment loss. Impairment loss recognized immediately in the P&L account. No other way of accounting impairment loss. VIU is basically it is your valuation which has been done for the purpose of that particular asset, you can say. Like how you value the business, you do the same future cash flow, do the same discounting, get value. For a SMC or SME company, there is a relaxation given because you don't have to go through the entire rigmarole of a VIU. Level 4, level 3, level 2, non-company entities, there's an exemption given. You can use only your net selling price. You don't have to do a VIU. Because VIU involves nothing but your calculation of your discounting of your future cash flows. Okay. VG Harish has asked whether impairment applies to investment in shares of other companies, whether valuations to be done for impairment. Valuation to be done only to calculate VIU. Second question I'll answer first. Only to do your value in use, you can do, you'll have to do a valuation, otherwise not required. As far as the shares are concerned, in the normal course, there will be no impairment because if you're doing a fair valuation of equity shares, it is assumed that the fair valuation includes impairment losses also. So if it's at cost, again, because you have the market prices, invariably if you have the market prices, we don't have to do a fair value. We don't have to do an impairment test because those prices are supposed to include the value of impairment also. So it will depend on the method of accounting here. And also it's very difficult for you to, how do you impair a share? How do you impair a valuation? Private limited company, yes, there could be a valuation for impairment. There could be an impairment loss. But normally quoted market price, may be difficult. That company in which investment has been done has done some fraud. Then gone. Fraud means again difficult only. But a typical private limited company wherein you have got no sources of market value, yes, you can do a valuation, you can do an impairment there also. You will have to do an impairment there also. In fact, I'll suggest you'll have to do an impairment because you know those indicators of impairment. I was just coming to the indicators of impairment, but anyway. External, internal. I told you about external sources. COVID itself is an external source. We know about it. Internal, asset not being used. asset being aggressively depreciated, asset not working up to capacity, asset not installed capacity is something else, actual capacity is very, very low. All these are indicators of impairment, which we will not know about it. Focuses again, put the blame back on the management only for this. Tell them, ask them for this. I'll also try and answer a very important question here. I'm sure this question is the back of many people's minds. I've always been telling you, okay, ask the management, ask the management. You ask the management. Sir, any impairment in March 22, so much of COVID and all has happened. Third wave, fourth wave, 10th wave, everything is coming. Did you have any assets which are impaired? And like all of us will probably agree, most management will say, no, sir, no impairment. For our company, no problems. Now we are back to normal, sir, no impairment. Subsequently, you all have observed an impairment has happened. What is your responsibility? What is your responsibility as an auditor? Next year, 31st March 23, management says, actually there was impairment. I forgot to tell you last year because I thought it will improve, but now it is really impaired. Go back to what I told you earlier. This is not something which the auditor can discover. Not something you can find out also. But when you are giving your notes on accounts, that is where you have the power. You can tell them that, look, you will have to mention that this was impaired last year also. It's only that this happened in the current year. Okay, we'll not worry about the intricacies of prior period and all those things for the purpose of this particular thing. So that's why it becomes important that external sources, internal sources, both only can be done by the management and not by the auditor. So to answer the question directly, in case an impairment has been missed out, there is hardly anybody who can question the auditor about this. But having said that, I will also give you all a word of caution here, which is that dramatic reduction in sales. Drastic reduction in sales. Last year, 600 crores, current year only 100 crores. A thinking auditor, professional skepticism is what the institute says, can definitely ask the question saying that 500 crores reduction in sales, something must definitely be impaired. Can you identify it and tell it to me? This is unfortunate because we have to ask the question because these are indicators of impairment. Okay, a company may come and tell you this is what is impaired, but they need not necessarily do this, what I'm trying to say. What about a company in which investment has been done, has been delisted and liquidated? Shall we impair the same? Absolutely, Samir. No need to even think twice about it. 100% impairment. No doubt about it at all. Unless the company has got some assets to be valued at something, then you may probably want to get into the valuation mode. But delisted, nothing is there. See, delisting is only an event. It's not necessarily an indicator for impairment. But they may have been delisted because of impairment reasons only. Some companies, don't want to delist, but SEBI delists them because they're not paying the fees and all those things. But I would also say it is an indicator of impairment, provided they don't have any assets. If they've got assets, then we have a different situation. You should get a valuation done. Invariably. Okay. Future cash flows, discounting, all this we have discussed. It is also a concept called as CGU, cash generating unit. What will you impair? The standard says individual asset you impair, no problem. Company has got 600 HP laptops. I cannot, say all the 600 have been impaired. You can use those 600 HP laptops as one CGU, which means that you're using it for the purpose of business. You're getting benefits and don't have to worry about individual laptops. Furniture and fixtures. Many of these can be classified into separate CGUs. Smallest unit for which cash generation can be identified. Definition of CGU. Can an impairment be reversed? Definitely yes, says the standard. Apart from goodwill. Now here, the standard gives us a little bit of a change and says that normal impairment I can reverse, goodwill I cannot reverse unless the impairment loss was caused by a specific external event. Typically, we would not want to, because goodwill itself cannot be seen But again, the fact remains that if it was because of some other reason than goodwill, then you can reverse goodwill also, they're trying to say. Indicators of fraud versus self-generated, obviously. Correct, sir. Naresh says correctly. It's obviously because self-generated. I should not be doing my reversal of goodwill because I got something, I impaired, I cannot bring it back, especially for goodwill. Others can be done because see, look at my calculation of impairment based on cash flows. Goodwill is not based on cash flows. So therefore, normally I would not want to, reverse my goodwill because those CGUs will become very important for the purpose of reversal. Disclosure, this is exactly what I told you, opening balance, impairment losses, amount of reversals has been reversed, all these things have to be mentioned here. But I would probably think that maybe what AS has missed out in this, which I think is a good practice for you to ask the company to disclose what is the indicator of impairment. Many of you are probably aware, COVID is coming as a key audit matter in many audit reports. And everybody's just been saying, okay, the company is looking at the impact of COVID, we'll look at it later on, we'll see what is the money later on. They're just giving you general statements. COVID itself can be an indicator of impairment. My only suggestion is, let the company give a small note saying what is the indicator of impairment. For example, the government may have removed a particular license. The government may have removed a particular permission given. Be indicator of impairment. This is where I'm saying, because this session is only about management, disclosure and all, I'm focusing less on the accounting part of it. I'm telling you all that, look at it from the point of view of the user of the financial statements, the management or the banker or who is the user of the financial statements. They are saying, okay, this company has got an impairment loss of 5 crores. The impairment loss came because government removed a restriction to or permission to use a particular land for some particular purpose. Government removed the landing rights in the airport for that particular company. That's where the impairment losses come. That I think is something which is missing right now. You can use this across all the ASs, not only from the point of view of intangible assets. Impairment, you can use it across all the ASs. Don't have to give too much of information, I will say, but at the same time, please give information which will make the users of the financial statements understand these financial statements more. Level 2 companies and level 3 companies, there is a value news basis. You don't have to do the detailed calculation, just have to do an estimate, which means that, see, normally what will happen in the practical scenario, what is happening in these level 2 companies is that if I've got an exemption from doing my value in use, I will take my net selling price only as a value here. I don't want to go back to this VIU concept at all. The last standard we're going to do today is this very interesting standard called as AS29, Provisions, Contingent Liabilities and Contingent Assets. It's a very simple standard. All of you are probably well versed in the nitty-gritty of the standard also. So I don't have to do anything from detailed explanation point of view, but just a couple of things which I thought I should tell you. Look at the definition. Present obligation from past event, they are saying is a liability. Liability which can be measured using estimations called as a provision. Present obligation from past event liability which can be used only with a degree of estimation is called as provision. Possible obligation from past event is called as a contingent liability. Possible asset from past event is called as a contingent asset. That's all over. AS29 has been completed for you. Exactly 45-50 seconds is required. Nothing else is required to be known. But we will have to look at a few things which are important. We call it as provision for audit fees. You look at the definition of a provision as per AS29. It says that liability which can be measured only using estimation. Audit fees is a pre-decided figure. I don't think we should call it as provision for it. It should actually become a liability itself. A provision should be required to, or the amount recognized as the best estimate of the expenditure which is required should not be discounted except for decommissioning, restoration, similar liabilities that are equal as a part of property, plant and equipment. So normally they are saying that best estimate and don't discount it apart from those what we can call as decommissioning costs, wherein you will put in the value of the machinery, you will add into the value of the machinery and create a liability for that extent also. Apart from that, don't create a provision is what they are saying. The standard also says that do not create a provision for future operating losses. And they also say that provisions should be reviewed every single year. Both of these are extremely important provisions, especially from the point of view of the auditor. All of us know this very well. Every company makes year-end provisions. They make year-end provisions for various types of expenditures. They make year-end provisions for many items on a regular basis they're going to use on a regular basis. Because the definition of a provision is a liability which will only be given, or which only requires a great degree of estimation, company can actually make a provision for any amount of liability. I'll give you all a small example because that will make this situation, what I'm trying to explain to you all, a little bit more clear. When Vodafone was fighting this income tax case in the Supreme Court, they asked a very prominent Supreme Court advocate whether he will, because just to give you all a background about the transaction, it was dismissed in the Bombay High Court, and in the sense that, the Bombay High Court ruled in favor of Vodafone, but the income tax department, as is their wont, went to the Supreme Court. One Supreme Court lower bench also went in favor of the Bombay High Court, but then it was referred to a larger bench. That was the history of what happened in the Vodafone case. So they asked a very prominent Supreme Court advocate whether he would be able to take up this case. He said, yeah, I'll do it, no problem. They asked him how much will it cost. He said, every time I go to the Supreme Court, I charge 25 lakhs, which means that every hearing will cost you 25 lakhs. Vodafone said, okay, fine, it's okay with us, but how many visits do you think it will take for you to go and close this case with the Supreme Court? And they said, yeah, it will take about 10 hearings. So the company, what they did, because of the possible obligation and estimation, present obligation, they said, okay, 25 lakhs into 10, 2 crore 50 lakhs of rupees, will create a provision. Simple. $25 lakhs into 10 hearings. They thought 10 hearings it will happen. But Supreme Court was in a hurry to close the case. The Supreme Court was in a hurry to close the case. They told the advocate that we will do this in 4 hearings only. Company has already made a provision for 10 hearings. In the 4th hearing, case dismissed and lost also. No problem at all. They had to reverse the provision because they made a provision based on an estimate. That estimate is changed. That is why AS 29 says, please review the provisions every year. No provision should be made for future operating losses. That also is a very important part. Whether it is necessary to make a provision in respect of unspent CSR amount, including for earlier years, and if not, what is the auditor responsibility? Very good question. YSK sir has asked this question. So I would look at it from the point of view of 2 situations here. One is the compliance as per the Companies Act. Whatever the Companies Act is saying, you've got to comply with it. Unspent CSR, you have to put in a separate bank account and all those things. Yeah. And you have to put it to a fund and all, whatever is that new Companies Act also. New revision to the CSR guidelines also. But purely from the point of view of accounting, suppose you have got an obligation for CSR, you should make a provision for it. The bank account is a compliance as per the Companies Act. That does not have anything to do with your provisioning here. AS 29 says, do you have a present? What is the past event? The past event is the obligation as per the company that have a CSR expenditure. 2% of average net profits. You are supposed to do it. Create a provision. Legal or constructive obligation is what they say. Legal obligation as per the Companies Act. So therefore, create a provision for that. Definitely have to create a provision for that. The bank account and all those things, the investor fund and all that is a compliance as per Companies Act. So do we not worry about that? If you stick to the accounting part of it, yes, definitely a provision has to be made. What is the auditor's responsibility? In case the company is not making, go back to Caro, you can see Caro last 2 points now, already included now. Caro has included both these points also now. In case of unspent CSR, what is to be done, all that has already been included in your Caro 2022. I call it as 2022 because it is 2020 only they say, but I call it as 2022. Already done, already taken care of for the point of view of. So please create a provision and there you can go and see what is to be done from the point of view of accounting. That's okay. Now the next part of it is, I think, disclosures, carrying amount, reconciliation. We are done with your AS 29 also. Opening balance, movement during the year, changes during the year, transfers during the year, what has been reversed during the year, unspent amount. Don't, you can give a disclosure. For a small and medium sized company and level 2, 3 and 4, level 2 non-company entities and level 3 and 4, all level 3 and 4 companies don't have to give those particular disclosures. The relaxation has been given only for the purpose of disclosures here. So I think with that, I have completed my presentation. So thank you very much. I will again hand it over to the Vijayawada branch. In case there are any questions, please feel free to ask those questions to me. I have got my email ID also here. As I told you all earlier, I have sent a copy of this presentation to the branch. You can pick it up from there. But in case you have any questions, please feel free to ask me. Thank you very much. Thank you. Sir, over to you, sir.
Okay, sir. Thank you. Thank you for your excellent presentation, sir. And also, you delivered your entire speech from beginning to till the end in same pitch, sir. Thank you.
Thank you, sir. Thank you very much.
Dear all members, please attend tomorrow program and enrich your knowledge. Tomorrow is the final session of this program. Please attend tomorrow. Signing up. Bye.
Thank you, sir.